All right, in this last section, we're going to talk about something called federal deposit insurance. So you might have heard of FDIC before. That's what we're talking about. So to start, we're going to talk about why the FDIC came into existence. So it came into existence because shortly after the stock market crash in 1929 that sparked the Great Depression, um, a lot of people ran to the bank and tried to get their money. And what happens when that happens? When people do that, the bank doesn't have all the money, right? Because of the fractional reserve system. And so this type of event is called a bank run, when everybody runs to the bank all at once and tries to get their money. Um, what happens is, since the bank doesn't have all of the money that everybody deposited, um, it leads to a failure of the bank, right? So bank runs are not good. It would cause our entire financial system to collapse if we were to all run to the bank at the same time and try to get our deposit out. Um, so in 1933, there was a peak in banking failures. People were just not confident, right, in the money supply. They were not confident in the financial system, right? Everybody was worried that the banks weren't going to have their money, right? So of course, if you're worried about that, you're going to run to the bank and try to get it before everybody else does, because you know that the bank only has a fraction of reserves on hand, right? And so there were a couple things that happened. The president at the time, uh, Franklin Delano Roosevelt, had a banking holiday, so he closed all of the banks for like a week. Said nobody can go to the bank. Banks can't operate for a week, to try to calm everybody down. And he even gave, I think that's when he started giving his fireside chats. He started talking to the public saying, hey, if everybody just calms down, the system will continue working as it has. But if you all freak out and run to the bank, it's going to collapse, right? Which has been happening. Not currently, had been happening. So he shut down the banks for like a week. It was called the banking holiday. And then very soon after that, the FDIC was created, the Federal Deposit Insurance Corporation, to basically guarantee, to alleviate people's panic, right? To say, okay, even if a bank fails, the FDIC will cover your deposits. They will make sure you get your money back, even if your bank fails, right? And so this is a way to prevent people from running on the bank, right? Because if you know your deposits are insured, then you're not going to run to the bank, right? Even if your bank fails, it's okay. FDIC they've got you covered, right? So it's basically this government agency that insures deposits. Um, and in order to be a bank in the United States, you have to have FDIC insurance. You have to be insured by the FDIC. And before the Great Recession, the maximum amount of insurance was $100,000, but because of that recession, and to prevent any panic, any bank runs during the Great Recession in 2008, they upped it to $250,000, $250,000, and that's where it is currently. All right, so in the next figure, we're going to see that bank failure rates have dropped dramatically since the passage of the legislation for FDIC. Um, Between 1933 and 1984, there were very few bank failures, but then it sort of jumped, actually, again in the early and late 2000s, which is probably also part of the reason they increased it from $100,000 to $250,000. All right, so here we go. We got bank failures before 1933, which is when FDIC was created, right? Pretty high rate of bank failures, right? A lot of banks closing because they were failing. They didn't have enough money to pay their depositors back because of those liabilities. And then, of course, here's right around when the stock market crash happened. Huge spike in bank failures. 4,000 banks at the peak failed. And then the creation of FDIC. So the banking holiday was probably right around here. And then since then, very few bank failures, right? Because nobody was as concerned anymore. Oh, if the bank fails, my money's safe. Great. I don't need to run to the bank, even if I think if the bank's gonna fail. It's not a big deal. Um, but then somewhere around the early to mid 80s, um, there was some different banking regulation going on, actually deregulation. So they were easing the restrictions on banks. And so banks were becoming a lot riskier with the money they lent. And as a result, there was actually an increase in the number of bank failures, pretty dramatic increase. Um, that went away after a while. I think there was some regulation that happened shortly after that. And then we can see here there were some bank failures right around 9/11 and the recession that followed there. And then, of course, there were a pretty substantial number of bank failures during the Great Recession. So, um, but that's because we had basically a total financial collapse during that time. So, the way that it works is that the FDIC basically charges premiums or monthly charges to banks, kind of like, you have to pay car insurance, right? You pay every month, you pay premiums for your car insurance. The banks do the same thing for FDIC insurance. And then those premiums go into a fund that will reimburse depositors in the event of a bank failure. And so, again, the whole point of this is to boost your confidence and your trust in the banking system so that you don't run to the bank and cause a banking failure. Now, until the 90s, all insured deposit institutions paid the same fee, regardless of how risky their assets were. But banks took advantage of this, right? They engaged in moral hazard. So they knew that they were insured, they knew they were covered, so they were riskier in their behavior. Moral hazard, right? So recall that concept. So because they knew they were covered, they had an incentive to be riskier with their investments, with their loans. And the FDIC and other federal agencies basically took that incentive away and said, all right, well, if you're going to be riskier, then you're going to pay higher premiums, right? And so higher capital requirements were imposed in the early 90s and 2000s, which is why the sort of uptrend in the 80s came back down in the early 90s. Right, so we've already talked about adverse selection and moral hazard with regard to lending, but it applies in an insurance context as well, and I've actually already talked to you about this, right? So adverse selection, again, is kind of seeking to get insurance because you know you're going to be in a risky situation in the near future. So that's adverse selection. You're selecting to get insurance because you know you're going to engage in some risky behavior. Whereas moral hazard is once you have the insurance, you then behave more risky and more risky behavior. In 2005, there was a reform of FDIC regulations. It basically expanded coverage of FDIC insurance, which probably increased moral hazard problems, right? So if you're expanding the amount of insurance that banks and institutions have, they're going to engage in riskier behavior once they have that insurance, right? Moral hazard. But it did provide the FDIC with some improved tools for addressing moral hazard risk. It altered a rule on FDIC deposit insurance premiums. So basically, if the insurance company knows that you're going to engage in riskier behavior after you are insured, if they have some way of monitoring your behavior, then they can at least charge you more money for the insurance, right? So, and that alleviates some of the moral hazard problems, right? If you know that if you engage in riskier behavior that you're going to have to pay more for insurance, then maybe you won't be as likely to engage in those risky behaviors. Think of it in terms of car insurance, right? The way that car insurance companies deal with this is they see your driving behavior in terms of like how many speeding tickets have you gotten? Have you been in car accidents, right? If you have, then they're going to charge you more money for insurance. And and hopefully you know that, right? And so you drive more carefully, knowing that if you get in a wreck or if you get a speeding ticket, that you'll get charged more money. There has been some structural reform since the banking troubles of the late 2000s, the Great Recession. So Congress has sought to increase the public's confidence in banks by temporarily extending FDIC to cover virtually all liabilities in the banking system. This may not be a good thing. Again, this is the expansion that we talked about just in the last slide that may cause to arise even more moral hazard problems. But we'll see. This one might come back to kick us in the butt at some point.